On the morning of September 18th, 1958, 60,000 residents of Fresno, California walked to their mailboxes and found a financial weapon inside. It wasn't a bill, it wasn't a flyer, it was a small paperboard card that would eventually dismantle the American concept of savings. Bank of America didn't ask anyone if they wanted this. They didn't run credit checks. They didn't ask for signatures. They simply mailed active, pre-approved credit cards to the entire city. Usually, a bank heist involves criminals breaking into a vault to take money out. This was the reverse. The bank broke into 60,000 homes to leave the money there. This experiment was called the Fresno Drop. It was a reckless disaster that nearly destroyed the biggest bank in the world. But in the wreckage, they discovered something terrifying. They had accidentally invented the modern debt economy. To understand why a bank would do something this dangerous, we have to look at the problem they were desperate to solve. In the late 1950s, banks had a strange problem. They had too much money. Post-war America was booming and bank vaults were flush with cash, but they had no efficient way to lend it out to the growing middle class. If you wanted to buy a house or a car, the bank could help you. But if you wanted to buy a refrigerator, a suit, or a lawnmower, the bank was useless. The administrative cost of processing a small loan for a toaster cost more than the interest the bank would ever make on it. So the average American relied on a chaotic mess of store-specific credit. You had a tab at the grocer, a charge plate for the department store, and a ledger at the gas station. It was heavy, inefficient, and localized. If you left town, your credit was worthless. Bankers knew the solution was a universal card, one piece of plastic that worked everywhere. But they were paralyzed by the chicken and the egg problem. Merchants refused to pay the bank a fee to accept a universal card unless thousands of customers already had it in their wallets. But customers wouldn't carry a new card unless thousands of merchants already accepted it. The system was gridlocked. The risk was too high for a merchant to install new equipment for a card nobody had. Nobody wanted to go first. Enter Joe Williams. Williams was a senior executive at Bank of America, and he was tired of waiting for the market to evolve naturally. He realized that logic wouldn't solve the gridlock. Only brute force would. He decided that if he couldn't get people to apply for the card, he would simply give it to them. He would manufacture demand out of thin air. He needed a test lab, a place big enough to provide real data, but isolated enough to contain the fallout if things went wrong. He chose Fresno, with 250,000 residents and 45% of the population already banking with Bank of America. It was a captive audience. Crucially, Fresno was geographically isolated. If the experiment exploded, the media blast radius wouldn't immediately reach the headquarters in San Francisco or the press in Los Angeles. Williams treated this like a military operation, setting up a secret division to develop the BankAmericard in total silence. He knew that if competitors caught wind of the plan, they would rush to market, and the first bank to drop the cards would win the war. The weapon Williams designed was fundamentally different from anything the public had seen. At the time, the prestigious Diners Club card existed, but it was a charge card. You had to pay the bill in full every month. It was a convenience tool for wealthy businessmen. Williams didn't want convenience, he wanted debt. The BankAmericard was designed to be a revolving debt instrument. It allowed you to buy today and pay whenever. It was the first true credit card designed for the middle class. The strategy for the drop was simple, and by modern standards, absolutely insane. They didn't use algorithms to assess risk. They didn't look at credit history. They simply took the mailing list of every Bank of America customer in Fresno and assumed they were good for the money. On September 18th, the invasion began. 60,000 envelopes hit Fresno mailboxes simultaneously. Inside each one was a live, activated paperboard BankAmericard. There was no activation number to call. There was no identity verification step. The bank simply assumed that if the mailman put the envelope in your box, you were the person on the label. It was the financial equivalent of leaving a loaded gun on a park bench. For the residents who opened their mail that afternoon, the reaction was a mix of confusion and euphoria. Most people had never seen a general-purpose credit card. They looked at the limit, usually $300 to $500, which was a significant amount of money in 1958, and realized they could buy appliances, clothes, and dinners without spending a dime of their own cash. The bank had removed every piece of friction from the transaction. You didn't even need to sign the card to make it valid. The sheer speed of the rollout was designed to shock the merchants into submission. Suddenly, every shop owner in Fresno had customers waving these little paper cards, demanding to use them. Williams' gamble was working. He had flooded the zone, but in his rush to bypass the application process, he had removed the only thing standing between the bank's vault and the criminal underworld: consent. He assumed the people receiving the cards were the honest customers on his list. He didn't account for the fact that mailboxes are not secure vaults, and he certainly didn't account for what happens when you hand free money to an entire city all at once. The silence of that first afternoon was just the fuse burning down. The flaw in the plan became obvious within hours. The cards were live the moment they left the distribution center. Almost immediately, the criminal element in Fresno realized that the bank had just distributed untraceable currency to every porch in the city. Organized rings of thieves started trailing the mail trucks, treating them like mobile vending machines. They would wait for the postman to turn the corner, walk up to the mailbox, and pluck the card out before the homeowner even got home from work. For the merchants, the system was a disaster waiting to happen. The entire network relied on a floor limit. If a customer wanted to buy something for under $50, the merchant didn't have to call the bank for authorization. They just took the card, placed it in a manual imprinter, the old zip-zap machines, and copied the numbers onto a carbon slip. The thieves figured this out instantly. They could go to a hardware store and buy $45 worth of tools, then walk the next door to a clothing store for $45 worth of shirts, and then go to a restaurant for a $45 dinner. As long as they stayed under the floor limit, nobody checked the balance. A single card with a $300 limit could be used to rack up thousands in fraudulent charges in a single afternoon, because the bank had no way of updating the balances in real time. Merchants were eventually given hot sheets, booklets of stolen card numbers they had to manually check against every customer, but the lists were weeks out of date the moment they were printed. But the real disaster wasn't just professional criminals, it was the credit criminal, ordinary, law-abiding citizens who simply couldn't handle the temptation. People who would never rob a bank were perfectly happy to max out a card they never asked for and then refuse to pay the bill. They rationalized it easily. The bank sent it after all. It was the bank's mistake. Delinquency rates didn't just rise, they exploded. Bank of America had calculated a worst-case scenario delinquency rate of 4%. In Fresno, it hit 22% almost immediately. Back at headquarters, the panic was absolute. The secrecy that Williams had enforced meant there was no contingency plan. They tried to recall the cards, but the genie was out of the bottle. You can't ask a city to return free money. The fraud was bleeding the bank dry. Joe Williams, the architect of the invasion, was fired. The experiment was labelled a catastrophe. However, amidst the wreckage of the Fresno Drop, the accountants noticed something strange. Yes, the fraud was rampant. Yes, the theft was out of control. But the people who were using the card legally were generating money at a rate the bank had never seen before. The interest payments from the revolving balances were astronomical. The bank realized they had stumbled upon a new classification of customer. In the old banking world, the ideal customer was someone who paid their debts on time and in full. In this new world, that person was a deadbeat, an industry term for someone who used the bank's money for a month and paid zero interest. The profitable customer was the revolver, the person who couldn't quite pay off the balance, rolling it over month after month at 18% interest. The Fresno disaster proved that if you gave people the option to spend money they didn't have, the majority would take it and they would pay for the privilege for the rest of their lives. The math was cold but undeniable. The 18% interest from the revolvers didn't just cover the losses from the fraud, it eclipsed the profits of traditional loans. To make the business model work, they just needed to fix the security. They introduced better verification systems and eventually the magnetic strip, which allowed for electronic authorization, closing the floor limit loophole that the Fresno thieves had exploited. With the fraud manageable, the profits from the interest were virtually unlimited. Bank of America franchised the system to other banks, creating a network that would eventually be rebranded as Visa. The invasion that started in Fresno was rolled out to the rest of the country. They had turned a local disaster into a national product. The heist wasn't the thieves stealing from the bank. It was the bank realizing they could legally siphon 18% from the average American's paycheck indefinitely. They had industrialized the concept of being broke, but there was one final hurdle to true global domination: state usury laws. Most states had caps on how much interest a bank could charge. This limited the profitability of the revolver. The solution came in 1978 with a Supreme Court decision called Marquette National Bank versus First of Omaha Service Corp. The court ruled that a bank could charge interest based on the laws of the state where the bank was located, not where the customer lived. This was the legal equivalent of the Fresno Drop. Banks immediately moved their credit card operations to states with the loosest regulations, like South Dakota and Delaware, which eliminated interest rate caps to attract the banking industry. Suddenly, a bank in Sioux Falls could issue a card to a customer in New York and charge them 25% interest, even if New York law forbade it. This opened the floodgates. The aggressive, unsolicited mailing tactics tested in Fresno became the industry standard. The modern pre-approved offer you get in the mail today is just a refined, less risky version of the 1958 drop. The legacy of Fresno is the complete transformation of the global economy. Before 1958, the American economy was largely based on savings and wages. You bought what you could afford. After Fresno, the economy shifted to being based on credit scores and perpetual debt. The bank didn't just invent a product, they engineered a behavioral shift. They proved that financial discipline was no match for convenience, and that if you put the ability to spend in a chaotic, frictionless format, the consumer would enslave themselves to the lender. The Fresno Drop wasn't a mistake, it was a prototype. That chaotic morning in 1958 didn't just change banking, it rewrote the psychological contract of the American economy. We moved from a nation of savers to a nation of subscribers, renting our lifestyles at 18% interest. The bank proved that the most profitable customer isn't the one who succeeds, but the one who struggles. We are all still living in Joe Williams' test lab. The only difference is, now there's no way to opt out. If you want to uncover more of the financial history they don't teach in school, hit that subscribe button. You can't win the game if you don't know who wrote the rules.